Welcome to my next edition of Technical Tuesdays. It's actually Tuesday the 12th of December today, 2017. So I've been asked to look at the average true range, the ATR. So the average true range not only measures the high and low of the day, but it also takes into account any gaps. So for example, this is a little gap here. The high here is 1328.80. The low of the next bar is 1331.55. So the average true range for this day would be taken from the high of 1328.80 up to, or high of the previous day, up to the next day's high of 1339.40. So you can see that that average true range would be just over 10 points. So that's the key. It's not just the high and low of the day, and then you add them up. The standard procedure is to add up the last 14 days of the average true range and then divide that by 14 to get that exponential moving average. So this is what gives us this smooth line you see down below. So for example, here when there was a lack of volatility, we were just crawling high with, as you can see, pretty quiet days, somewhere in the region of maybe 10 to 13 bars on average. Well, anyway, the average true range will tell us what it was. 12.4, 11.9. So you can see it's around the sort of 12 area, and then as it gets less volatile, you can see the ATR dipping a little bit. As the market then begins to get more volatile, and you can see some bigger bars starting to appear here, then of course the average true range picks up, telling us that the average true range is heading towards the 13 value area, and eventually we get up as high as 15.88 as the bigger bars obviously continue, and then obviously the smaller bars drop out of the equation as we continue to move forward. So the average true range is a measure of volatility, and at a very quick glance you can easily tell how volatile the market is. Now of course gold, which we're looking at the moment, has become rather unvolatile as we head towards Christmas, and that value has dropped back down to 11.18. so we're seeing an average true range of around $11-12 a day, and you can see that the candles are becoming much smaller. How does that help us with our trading? Okay, so how do we use this for trading purposes? Let's have a look at this trend line here. So if we have spotted that the market is in a short-term bull trend and we are looking to buy on the dips, so this would have been a good point. Obviously at this point we wouldn't have known that this was going to be a trend line because we wouldn't know it had bottomed here, but let's just say that we've spotted this 1 month upward moving trend and we've decided to buy on the dip back to the 100-day moving average. What we could do is let's say we got in at 12.55 towards the low end of the day. Well, let's see, where is the 100-day moving average? That's around 12.55. So let's say we got in at 12.55. We look at the average true range. What have we got? 11.91. Let's call that 12. So you could say, well, right, well, let's put a stop in 13 points below our low of the day, which would be 12.51, and hopefully that will keep us in the trade if we're in a bull trend, and will keep us out of trouble on any little spike down, because hopefully the spike down will not be greater than the average true range. And then if that works, we can keep going, and we can actually trail the stop up perhaps at the close of every close of the day. We can trail the stop up by the amount of the average true range. So as the average true range grows, perhaps we'll need to not widen the stop, we'll trail the stop by an increasing amount. So for example, if you're only trailing the stop by 12 points here, you might need to be trailing the stop by 13 or 14 points as the average true range grows. So that's one way of using it. That's one way that you could potentially stay in a profitable trade using the trailing stop. You could also, if you're a day scalper, you could use the average true range to exit a position. So if you manage to get in around what you think is the low for the day, you might be looking for the average true range as a target on the upside for your long position. A lot of traders like to sort of fade the volatility. So when they see volatility has increased and is where they think, they think at a high level, they might want to start selling volatility. So just looking at the average true range is a nice easy way to get some guidance on whether we're at a relatively high or relatively low volatility. And of course at the moment this looks relatively low based on history, around 11.18. Well, not surprising as we head towards Christmas, of course, but you can see as I scrunch the chart up going back, we haven't been much lower than that for a long time. So volatility might turn around and pick up. If you're a vol trader, you might be thinking about starting to buy into options in order to gain exposure to some volatility. As a very general rule, markets tend to go down faster than they go up. That's not always the case, but and as you can see here, the market rallied and the average true range actually increased, so it's not a hard and fast rule. But when you see stock markets, for example, certainly do tend to increase in volatility, so their average true range does tend to increase when they go down, and of course the VIX tends to go up quite quickly when the stock market, when the S&P falls. I don't think I can really say much more about it. It's very simple, but it's worth understanding and it's worth keeping an eye on and seeing if you can use it in a practical way with your trading.